let's move on to the stock I've been looking at. It's one that Steve knows quite well, to be honest, because a good amount of this is lifted out of a Business Breakdowns podcast. If you're interested, we would strongly recommend that for what it's worth listening to, either this episode or probably any of the others. I haven't heard one on there that I didn't think was extremely high quality. The academic in me, which is my kind of day job, refuses to present this research as entirely my own, and I should point out that if I say everything and ascribe every bit of it to the podcast, I'll be saying that after every sentence. But a lot of this is lifted from there. Some of this is lifted from some other places where I've been looking. Absolutely do check out that podcast if you're interested in finding out more about this stock. But this stock is called Diploma. It's listed on the FTSE. It's a FTSE 250 stock. You start with some numbers, Steve. Let's start with some numbers of our own here. It has about £80 million in tangible assets and produces about £116 million in operating income, which is about 144% return annually on its net tangible assets, so the ones that have been depreciated. For context, Google, which is a company that we both loan and like, returns about 70%. Meta returns about 62%. These are fairly asset-light businesses, but Diploma's getting a better return out of the assets it has, at least by that metric. And then of that 116 million, I said I was going to talk about cash conversion. About 92.5% of that becomes free cash. So it's not queuing up huge amounts of capital. That goes down to that bottom line, becomes cash that they can do things with, the things you do with free cash, like pay down debt. There isn't a huge amount of debt, but you could pay down some debt with it, return it to shareholders via a dividend, do share buybacks, buy other things, which is mostly what they do with it, or leave it on the balance sheet, which isn't what they do. But again, for context then, so 92.5%, I said Google has a cash conversion by that metric about 83%, Meta's about 90%. So business with some nice looking metrics. Question then, what the hell does this company do? It's not a software platform, which is what it sounds like based on those numbers. And with a name like Diploma, it could be basically anything. But what it is a conglomerate. So I like conglomerates a lot. It's made of loads of smaller businesses, and those businesses are focused on basically industrial distribution, usually industrial distribution of components. So it's about as uninteresting as it sounds, but they tend to focus on components that are, one, essential, and two, inexpensive. So it's boring little bits that replace on machines. But if your machine is broken and you need a spare part for it, it's not going to cost very much to fit, but your machine won't work without it. So it makes it highly likely that people are going to buy them. And they're going to buy them out of their operating budgets, which is what Diploma's targeting, rather than their CapEx budgets, their expansion budgets, which means that if we get a kind of economic downturn, Diploma's hoping to get some protection against that. So being in the industrial space, you kind of think, look, we could do with a strong economy, more people making stuff, more people doing stuff, more people building stuff. That's what we really need to kind of push demand along for our company here. But in Diploma's case, they only sell kind of small things anyway, and you think that if you've got a broken bit of machinery, you're probably going to fix that for a relatively low cost, 20 quid, $20 for another component of some sort. I'll get on to what components in a second. That's going to protect them a little bit against cyclicality. So they break their business down into three segments. There's controls, which is 45% of revenue, seals, which is 32%, and life sciences, which is 23%. And each of those is focused on a couple of things. One is adding value rather than just being a distributor, and the other is looking for a moat that involves operating in some sort of niche area. So controls, the kind of value add, this involves stuff like cables, cable fasteners, all those sorts of things. And the value add there comes from the fact they offer a really bespoke service. So they have engineers that will work with companies that need specific cables cut to specific lengths with specific pressure resistance and so on. Diploma's engineers can work with them and find a nice way of sourcing that. And this will add some value for them along the way and help them to charge a bit of a premium. So they're a kind of middleman in all of these things. They're between manufacturers and buyers, and it's tempting to try and cut out middlemen with these things to be more efficient, go direct to consumer or buy direct from manufacturer. But you lose something along the way. You lose the kind of bespoke service, the kind of engineering expertise, I was going to say. Seals. This is basically stuff that, like, I think of this like washers, basically, and those sorts of things that help kind of bits join up reasonably well. They do wear out, they do break, and Diploma's big advantage here is that it has a huge scale, which means it can get these things to places fast, because if you have a broken bit of machinery, you don't want it broken, you want it doing stuff and making money for you. They can get things faster than anybody else can, apart from perhaps original equipment manufacturers, but OEMs charge more for them. So they're a nice combination of speed and efficiency. And then there's life sciences, which is sort of 23% of their revenues, which is everywhere seems to have a kind of arm in this that I can see, but it's equipment and it's consumables in this case. So they have distribution in Australia, Canada, UK, Europe, not really America where that's all private hospitals and stuff. But if you're a small kind of medical device or medical component producing company and you want to sell your stuff into Canada but you don't currently have distribution in Canada, Diploma can distribute for you and stop you needing to set everything up to do that yourself. Okay, what's positive about this business? Well, it's a value-add thing, so we get operating margins between 13 and 17%, which is more than you would expect from a kind of big warehouse distributor type thing, which tells you there's something going on here more than just having a great big warehouse full of stuff. It's made up of a lot of smaller businesses, which gives you some reasonable degree of diversification, I guess. If one of them goes wrong, you're not going to go too far wrong overall. But they're all occupying big positions in small areas. I've talked about this quite a lot as a kind of moat that I like. Something that has a dominant position in an area that's quite small, so it's not really worth it to anyone else to come and try and disrupt them. But they're able to fend off smaller companies by their sheer size relative to the size of the market they're dealing in. They're also decentralised, a bit like Berkshire is, so the businesses all go off and run themselves in their own way. They encourage cooperation and then so on and so forth, and they do try and improve things like accountancy where they can. But in general, they're keen to let people get on with doing what they do best, and they're acquiring businesses that do that sort of thing. Risks, two main ones. First is the price. Price earnings of 42 is quite high, even if most of those earnings are going to make their way through to free cash flow. I'm kind of wary of companies at the moment where, especially in this kind of sector, Charlie Munger talks about, I think he's talking about farm machinery for what it's worth, when he says he owned stuff in a farm machinery company, and every year there's your profit sat in the yard. It's a big piece of farm machinery. It never seems to make any kind of cash. It's forever getting used back in the business again. The cash does flow through here, but 42 is quite a high PE, even for a really good one, that converts quite well and has quite good margins. Second is the growth by acquisition thing. There's lots more to say about this, but they have a relatively new CEO, and Diploma has built itself as conglomerates do by just adding on more businesses, and they've been attempting to acquire things on EBIT multiples, which is where their focus is for reasons I'm not quite sure of, at single digits. Their new CEO thinks, look, that's okay, but we can do better if we spend a little bit more and go for some slightly better double-digit things. That's worked fairly well, but I'm a little bit wary of overpaying for acquisitions. I think that risk goes up if you think, well, look, we should be a bit more ambitious, a bit more relaxed about kind of paying the higher multiples. So for me, I'd love to own this stock. I may well own it by the time, the way the market's coming down, I may well own this by the time this podcast goes out. It's Thursday today, by the way, so I got 24 hours or so to get hold of this by the time the podcast goes out if I want to. The dream would be around 20, but I'm not sure I'll be patient enough to wait it past 22 if it gets there. It's come down under 25 for the moment, so I'm watching this space quite carefully. At 22, I think it looks good. At 20, I think it looks great. This is going to be one that I will edge into slowly if I do it. But I like this company an awful lot, and I'd be quite happy to put large amounts of money in here at the right kind of price. Steve, you've heard the business breakdowns thing with the longer version of what I offered you there. What do you think about this?
Well, I think I sent it to you, didn't I?
Yes, you did. Yeah,
I did. Yes, to say, have a look at this. This is great. Yeah, I say same as you. I think this is a great company. I've got some questions there for you, Steve. That would be maybe that we could touch on a little bit. So, yep. Bruce Thompson was the original CEO that you mentioned had retired, and hence they replaced him. But they actually replaced him with somebody called Richard Ingram in the meantime. But he didn't last very long. Do you want to just touch on what happened to him? And I guess, does this show the strength of the sort of board that they have at Diploma?
Yes, he was destroyed in an accident involving some of Diploma's farm machinery. No, he came out of, I think it was Compass's Food and Beverages or catering organisation or something like that. So he was much more corporate, much more centralised than either Bruce Thompson or Johnny Thompson. No relation as far as I'm aware, by the way, between those two. And so one of Diploma's strengths, I kind of alluded to, is their sort of decentralised culture. Richard Ingram was far more out of a kind of corporate centralised world, and they got shot of him within about 4 months, I think, or within a quarter or something along those lines. So they're not scared to kind of swing the axe at the top, but I think they're pleased with their kind of new manager. You can make of that kind of what you will, I guess, but I suppose it means they're confident in their culture, and if you agree with that culture, then it's a probably fairly well entrenched thing.
Yeah, and that is just to add on to that. That does show you the strength of having an independent chairperson and an independent board, because they're not beholden to what the CEO says and does. If they think, perhaps that they've made a mistake and they're prepared to wield the axe, that's a really good thing. It can be good and bad. It can breed nepotism and what have you. But in this occasion, I think what they've said is this is too big of a change. Diploma is this conglomerate that leads from afar almost, and to try and bring everything in house was perhaps a radical change that they didn't want to do. Just before we shuffle on, Steve, what do you think is the big moat here? Is the big moat the distribution? Is the big moat that they carry more inventory than anybody else? Is the big moat that they're cheaper than the OEMs? Is the big moat that they have the engineering people who can, help independent machinists figure out what seal is needed? Is it all of those things? Does it have a big moat?
I think it depends on what kind of... I think Morningstar calls their moat narrow for what it's worth, but I've said before, I think that's a slightly idiosyncratic way of thinking about moats that Morningstar has. So I think could be any of those, but not necessarily all of those. So they divide themselves up into control, seals, and life sciences, I guess. Engineering expertise goes under controls, I suppose. Seals, I'm not so convinced that this big range, this massive inventory they have. This is the part where I disagreed with the breakdown podcast for what it was worth. It's probably probably true for what it's worth that they have a bigger range of stuff than anyone else has. I'm not quite sure why that makes that desirable. I mean, it's pointed out that there's a few other places that will stock the kind of major seals and the most commonly used things. Why, if I only want the most commonly used things, I would care that Diploma stocks a bunch of stuff that I don't have, I didn't quite grasp. So, fast distribution, absolutely. The kind of moat thing that appeals to me here is more just the kind of niche market stuff that they operate in. This is something I'm well known to be maybe a sucker for, but certainly very fond of in my thinking. So I own a bunch of, or I've looked very carefully at a bunch of companies that do that. This one has a load of them. They're a lot smaller than the ones I was looking at. I said conglomerate, by the way. That makes it sound kind of big, right? I mean, it's got about a 3 billion market cap, 3.1 earlier today when I looked. So, I mean, compared to a lot of the stuff we look at, that is tiny. I mean, it's the kind of thing that it would make no sense for Berkshire to acquire because it's not big enough to make a difference to anything one way or another. So I really like this as a kind of smaller thing, but the most impressive moat to me is the kind of lots of companies, big position, going to fend off competition like that.
Yeah, just having a look at its stock charts on it reminded me that it did have a bit of a checkered past, didn't it? It had since inception, it had like a 16, 17-year period where it did absolutely nothing. And then they announced this new turnaround plan. And if you'd have bought it on that day, Steve, you would be up 25x today in the space of 12 years. So that's a lot. That's a lot.
And that's not factoring in the enormous 1.8% dividend, right?
It isn't, no.
No, which I think that's growing at about 12% for what it's worth. I think revenue's growing at around the same rate, and there's a decent amount of operating leverage, which pushes operating margins, operating income higher, and EPS higher in terms of growth. But yeah, that's Diploma covered. I'm fond of this. Steve is as well. He was kind enough to let me have this one, but I think we both like this one. I've got a very close eye on it right now.
Yeah, I think it's one of those it's a hidden business in the FTSE 250, and it's probably what makes the FTSE 250 such a good index.
Yeah. Yeah, it hasn't actually come down massively. I was looking at the FTSE 250 since the start of the year, and I think that's down about 25%. I have a feeling Diploma is down less. I've not paid as much attention to how much it once was as what price I'd like to buy it at and how far is it from there. So to be honest, if it's been cut in half since the start of the year, that doesn't make me want to buy it any more above the number I kind of worked out, but as opposed to if it's actually held up fairly well.
Yeah, down 26.32% year to date.
Okay, about in line with its index then in that case, if you think of the 250 as the relevant one.
If you flick it to a year, it had a bit of a run-up as well, up into December, and then we all know what happened from that point onwards. So, yeah, it's had a pretty sizable fall year to date.